Well, good morning, everyone. Show it's about 11 o'clock, so I think I'll get started. I'm sure some others will probably join us once we move along. I will also be checking the chat part of this periodically. So, if you have additional questions you guys didn't send in before we started, I'll try to address them. What I've done for today is this yesterday and this morning I put together some slides in a PowerPoint because I thought it might be more effective initially than switching between platforms. But then we'll go to one or two of the platforms that I use. A little background might be helpful. In the before the 1982 recession bear market bottom, I changed from being a biochemist to a financial analyst. Since I was doing computer analysis of proteins at that point. And prior to that, I'd spent several years studying past history in the stock market, going back into the bear market of 73, 74, as well as some of the other market action. And that was sort of the what I used to generate my methodology. And of course, it's refined over the years. One thing I've noticed is throughout history, a number of financial panics have occurred. At the time, all of them were, somewhat unprecedented. You could make a case that the current one we're undergoing is probably outside the norm of most of the last 30, 40 years. Back in 1907, if I can, let me see if I can advance this thing. There was a financial panic that was actually if you search Banker's Panic of 1907, you'll get, and if I have time at the end, I'll show you, it's pretty interesting. Essentially was started by a couple of guys who wanted to corner an individual stock of a copper miner in New York. It was a copper mine that was it was formed in Butte, Montana, from which I actually know where it is. In any case, so it caused a run on the banks. And so essentially, all the big bankers at the time, Morgan, it's just Rockefeller, had to get together and keep the banks solvent at that stage. And the market really got hit there. The chart was pretty. This orange part, you can see what kind of decline one had then. And up on top of that, somebody's done a comparison to, the 2007 bear market. And what I hope today's talk will explain is that there's reoccurring phenomenon and patterns that I see in any type of market, and I don't think this is any different. And there's a reversion to the mean. You get too far above the mean. Those of you who have a math background will know especially what this is. But essentially, when things get stretched very far in either direction, they do come back. And I don't think this is any different. We don't, as I said, early in the year when no one seemed to be worried about the virus, that we really didn't have the information, and we still don't. Some of the information we're seeing, out of the countries is pretty alarming. And, some of the forecasts are very alarming. I think probably a lot of people in the market are reading those most negative scenarios. I can't, as a scientist, I can't say they aren't true or won't be true. But all I can tell you is that I think if we're smart, safe, and isolate, I think the majority of us come through it. And I think the markets, more importantly, will come through it. So, that's, I think I had laid out a couple of points in publications last week about, what I see as a likely scenario. And as we get further into this, I will go into that again. And also, of course, if you have any questions when we get to that part of it, feel free to ask up. But you can see, in 2007, we had an 18% decline. We had a rally. We'll talk about this rally. I was writing about it, and write about it in here, said that was a classic bear market rally. I have a link to an article. Unfortunately, the charts have disappeared into internet heaven, apparently, but it had all the characteristics. So, whether we're right in here, or still in here, hard to say. But the bottom line is that, you got a pretty good advance. First there's got to be a bottom. That last week's action looked a little more encouraging heading into the afternoon of trading. Unfortunately, it's not political, but I kind of wish we wouldn't have those daily press conferences. They really didn't help the market. Any of you were watching it tick by tick. It was, I think the Dow was only down like 140, and then by the end of the press conference, it was down 700. So I don't think they're helping matters. And I'm pretty sure that we will see some sort of action out of the government that's maybe more reassuring. But in any case, after a rally, then the odds are you're going to head back to the lows, as we'll talk in some charts, or to new lows. Now that part, it depends, in my experience, a bit on what kind of rally we do see. So right now, I see us in this sort of bottoming process. We need a couple of days on the upside, and we'll get into that a little later, to suggest a short-term low. Then we're likely to get a pretty good bounce, and then we're probably going to see a drop back to whatever the low is we make either last Friday or next week, and that will be a key test. So this is an interesting hourly chart of last week's action. Shows you pretty much how bad it was. And 31.93% below the record close, down 28.66 year to date. You can see Monday, Tuesday, Wednesday, Thursday started to improve the action, and this was right about when the press conference was going on, and you can see what happened after that. Things really tanked. And but these hourly charts, I think, in this type of market are going to give you some really good clues as to how to be well prepared. If you're whether you're in a position you want to try to lighten up or liquidate, or whether you're taking a new position. We'll talk about some of the techniques you can use to help monitor the market, and most of you can do on stock charts for free. You don't have to be a member. So that's and we'll get into that more in a little more detail. So I just released an article this morning, 3 past bear markets to study. It's in Forbes, so you can always search Forbes and Tom Asprey, and you'll see it. We'll talk about some of those charts today. A lot of these I was very involved in the market. This one in particular, was in 1998. It kind of came out of the blue. It had been quite a strong market up to that. The Russian ruble collapsed. Russia started, interestingly enough, was the head of this one, but not in a good way, not paying their debts, etc. And the market made a high in July 20th, I remember the day well, and had a pretty amazing decline into early September, this point B. And we had, a rebound up to point C, and then a new low into October. Some of you may have heard of long-term capital management. I think it was either 2 or 3 Nobel Prize-winning economists put together this hedge fund that was capturing small differences in interest rates, and seemed foolproof until it wasn't, of course, and so they had to be bailed out. At that time, it was just, I think, I don't know, probably a handful of billions. Wasn't too bad, but in the greater scheme of things, you can see this first part of the decline. We really haven't even seen this phase yet in our current market. We kind of stabilized. We saw a little bit of a bounce. It may not look like much, but it was about about a 7-8% rally, I believe, up in here back in those days, and then we saw another heavy wave of selling, and then we saw a very strong rally. It went from 940 up to 1060 or so. So that was a good one, and then one more drop. You can see the AD line, stayed pretty negative, after it broke down here. Stayed pretty negative until October, where it broke a downtrend and then moved above its high. So AD line did fairly well in that one. A couple other ones I talk about in the article were in 61 and 62. This was the early part of the Kennedy administration. He'd been in office about a year, and he'd been promising that the great strength of the prior administration was going to continue, and sort of, the market just sort of ran out of gas in here. And you can see, oftentimes, this is a more typical pattern. Obviously, we didn't see it this time. You see a 8% decline, you see a 5.8% rebound, and then the sellers really take over. You can see the AD line had been diverging. Last week's article in Forbes.com, I showed it was pretty clear divergences, very similar to what we saw in 61 and 62. AD line topped out, market kept moving higher, AD line kept moving lower. And, we didn't have any of those divergences between price and the AD lines. If you compare NYSE stocks only, it started to diverge but we don't have a measure of only the stocks in the NYSE, so it wasn't a clear divergence. In any case, this leg from up 5.8 got you down 28.1, 29.7 from the low, 17% rally. So this is sort of, I think that this rally is definitely in the cards for us, if not more, in the next couple of months, and probably more. AD line turned around in November and started to move higher, and fairly soon the market was at a new high. 66, this was a credit crunch. We didn't have, some of the similar problems today, and the fact that at that point the Vietnam War was costing a whole lot of money, and businesses were doing well, so they were trying to borrow. The government was trying to borrow. We were on the gold standard, so there was, it was sort of a different system than we have now. Similar sort of breakdown in the AD line, in February, 8.3%, 8.1% drop, 7.3% rally. Then it got pretty ugly, and then that was it. That's that was a real short, a one, as the table indicated. The other one that was equally short was, of course, 87. And this is pretty much a waterfall decline here we had, and got into the last week. We had a day that was the biggest one-day decline since 87. This rally went from like 225, up just like a 50-point S&P rally, so it's about 20% bounce, then another drop, and then this sort of basing process, and until the AD line turned around early in the year. So that first 2 months after a decline like this is usually the most interesting and most important. Obviously, in this case, will probably depend on a little bit to what kind of news we actually get, what it means. And I'll address some of those since I have some questions from some of you regarding what I think about that, and we'll talk about in a bit. So this is the 2007 top, and that's the bear market rally. That was pretty much, sort of an exhaustion thing. So, once I said, I think the magnitude you can't necessarily compare, but, somewhere, we haven't seen this sort of rally yet, so whether we're, in this sort of phase and we're going to bottom out next week and see a pretty sharp rebound, there's some stocks are starting to buck the downtrend, and then another wave of selling back to that low, or is it going to be like this? It'll be, below that low. At this point, you can, I think the best thing that says not too much below it is that, the next major support, now for the S&P is, though this one has clearly gone further than I anticipated, is about 150 points below where we closed on Friday, and 150 points in today's, market is almost a rounding error. The AD line back in March, this rally lasted just long enough, and if we see something like this, then we really didn't. You can look at the retracement levels. We won't talk about that today, but I may go into it later. Once we finally see a bottom, we may do another one of these if anyone's interested. It got up to about 1440. You can see the 61.8% retracement was 1453.77. So we failed up there. Turned out where this arrow is, we formed a doji, closed below it the next day, so it was a doji sell signal. And of course, we eventually dropped down to 666 in the S&P, so quite a bit below where we were there. The AD line had topped out at that point, and it rolled over. So that long rally was just lasted long enough to change people's mind. I think you are going to see such a rally, where increase in unemployment that some of the brokerage firms are projecting. Most of I don't have a lot of faith in their analysis. Something's going to probably change and make people think that, hey, it's all over. So I think the charts and the supply and demand will be the best way to determine whether they're right. So this was an article I wrote at the time, about why it was a classic bear market rally. Probably search that title in Google and you'll see the text about it. Talked about what happened in Tokyo and a couple other markets that were, pretty informative. So, what are we going to see when the worst is over? You're going to start to see groups or sectors or stocks emerging. So in the past week or so, I've looking, referred you to some candle glance charts from stock charts, and we will look at these today as well. And it kind of allows you to. So anyway, I don't know if any of you saw this part. It was I was checking the chat to see if that was my problem. So bear market rallies, they have some pretty interesting characteristics, and throughout time, they've been replicated. So I think that's something to look forward to, try to understand. So I was mentioning, in the end of the bear market, the last bear market, we started to see, certain sectors, technology mainly, so the QQQs, the XLK, even the healthcare started to bottom out first. And, you want to remember, some of you may not have been with me for a long time, but the positive RS doesn't mean that the market is necessarily bottoming. It just means it's doing better than the S&P. So there are some stocks that are definitely doing better than the S&P right now. And, because it's hard not to. Before the market topped out, there are a lot of stocks that were had weak relative performance because they couldn't keep up with the S&P. So, looking back at the XLK, we've gotten down to some support at 69.45 level. Then below that, you get down into the mid 60 level. You can see the RS here is still positive. The unbalanced volume flipped back, but now, is negative. It's still showing that, it's not as weak as it was in the middle of last year. And certainly at this point is well above the 2018 low. So let's look at the XLK now. This is a daily chart. So you have to, of course, look at these retracement levels. If we make a new low, all these numbers are null and void. But you can see what the daily RS looks like. It looks pretty positive. OBV, is negative still. So, the first thing you'd want to see from the OBV is you get above this peak and that peak. So you can vision if you got a couple of good up days early in the week, this would bottom out. So if that's the case, we're right near the monthly S2 support level. So you're sort of your minimum target at this point, is probably, the 38% retracement is still quite a ways away. So we're at 71.42. So it's 11 points up, so, basically it's a 15% move to get it back to here, roughly, so, and up to the 50%, it's about a 20% move. So, as like I teach and I talk about in presentations, the fact that the 20-day moving average is still declining like this, is a sign that you would not expect the first rally up to mark an important low. In other words, it's going to be more likely to be a rebound within the downtrend. If you're a short-term trader or you're looking to lighten up a position based on this, it's definitely, worth working, and you should drill down, to the hourly charts at that point to pinpoint your entries and your exits. But that's essentially what, we're looking at. And if you look at the, a broader sense, the VGT, that's the Vanguard information. It doesn't have as high a concentration, I don't believe, in Apple. So it's a little different mix. You can see it's broken below that June low. So 104.08, was broken on Friday's session, or last week anyway. And so, it's got support down here more in the 175 area. Similar patterns on both the RS and the OBV there. And, we're not seeing any real signs of a bottom yet in something like the semiconductors. So how about the sentiment? Sentiment is one thing, some of you asked about, what about the sentiment numbers? And they were definitely puzzling last week. Let's look at this. This is the NAIM. This is a equity exposure index. If you Google NAIM, you'll see, and they printed out Thursday afternoons as their latest reading. It went from 16% a week ago to 10% this week. They tell you shouldn't use it as a marking timing indicator. That's what it's designed for. But we've been talking about it for a while, and you can see that it's a pretty good indicator. in the fall of 2018, you can see it started to diverge. And then, it was sort of, when the market was topping out in September and early October, it had already topped out. And conversely, at the low at the end of 2018, it formed higher lows. So it pulls back, and this was the June low, the correction in June low. I was on the phone with a client. We were looking at this that week, and we said, well, okay, it's gotten right back down to this level. It should turn up this week, and it did. But as we got into the latter part of 2019 and early 2020, you can see we had sort of quite a negative pattern here. A series of higher lows, this red line. And so, this is a sign that they were dumping positions, and now they're probably nibbling back on the long side, I would think. Below this, we have the percentage of bullish in the Aaii, which is you can look at this in two ways. It's at 34. I think I'm on record saying I thought it would be in the low 20s last week, so definitely wrong on that. You can see that's usually the level that it gets down to. Those of you who've been following me since 2016, it got down to the teens. So I think it was 17.9. And, I have a database of all the numbers. I had to go back to 2005 to find a lower reading. So all throughout the bear market, 2007, 2008, it never got below minus 19 or 19% bullish, I think. So right now we're at 34.4. So, they can be right periodically. So that's one interpretation. The other interpretation is that, that they are still more selling to go. Given the volumes we've seen, it's a little problematic explaining why there is so much volume if the investors haven't been selling stock. So we'll see that the bearish percentage is up around 51%, I think. That's close to levels that we'd often see at an important low, but not yet. You can see that any measure of oversold basis on banding techniques is really over the top, and you can see this 23.46 low from last year that we broke that last week. So here's a little longer term look at some of these numbers. You can see that we got up to like 60% almost in early 2018. Never got that bullish this year, and so back here, this is what I was talking about in early 2016 at that low. I had a nice divergence here at that low, and you can see at that point, the bearish percentage was just under 50%. We're at 51% now. But the only one you can see that's as high as during just a very brief correction in April of 2013. It was a really strong market at that point, but it spiked then to that level. Usually, those of you who have read my stuff for a while, I find the percent bullish to be more reliable. So, before it's going to signal an important low, it's got to get down there and stay down there. And more importantly, the AD lines have to start turning around, and that's not happening. This chart of the S&P shows that now that we've, 2,300, it helps you see some sort of good support levels, 2193, 2134, 2116, sort of, somewhere between, 2193 and 2304, down to, this whole band of support in 2015. If you remember, those of you who were trading, right at this point, when we got down to 1810, everyone was convinced that we were in a new recession. Earnings had been bad for 6-8 quarters, I believe, at that point. And, though it's really impossible to really estimate what the earnings are going to be this time around, it's the prolonged negative earnings that usually cause the longer term slides in the past. And so, this was a real good example of that. So some other slight, positives we're seeing from the market. The McClellan oscillator is diverging. Okay, it made a low here, like I think it was minus 392 or something. It's back up here. It started to, the breadth weather wasn't that bad on Friday, even though the market price action was. So, that doesn't mean it can't drop back into that level. But now, if it gets back above, probably this I think is the minus 100 level right here, gets back above that, then it's going to, typically you would expect a rally back towards the zero line. So those of you who are looking for a rally to short, reduce your equity exposure, or if you're trading the long side for a scalp, you can keep your eye on the McClellan oscillator. It's also available in stock charts. You don't have to be a subscriber, but if you aren't sure of the symbol, if I can probably put together a list for everyone, or do what I do and just Google stock charts McClellan oscillator symbol, and you'll come up with it. Typically, in a initial failed rebound, you'll see a move back to the zero line before it's over. So, if my scenario is, a rally, say, so we're at 91.33, so a 10%, move, on that would be up to about 10,000. 15% would be about, to 10,000 or 10,500, say up in here. You're going to have some time for that, AD numbers to turn a bit more positive than they have been. Take the McClellan oscillator back up of the zero line. It may go sideways for a few bars, and then if you're watching the AD numbers intraday, you can probably do a pretty good job of either establishing new short positions, getting out of your longs, or lightening your equity load. So this is from advisor perspective. There's some nice stuff on it. Kind of what's happened to the sectors, so far in this decline. You can see technology, is the best of the worst after consumer staples. Some pretty hotels, obviously. I got some questions last week about, well, would you be bottom fishing in the travel? It makes me nervous. I mean, I think I told the person that, probably the airlines, like I think Southwest and Delta, though I heard Delta yesterday, they sent a letter out that they were burning through 50 million a day, which is not too reassuring. Love, I think, or Southwest has the lowest debt. So I think that's going to be important to see what kind of a debt a company has. Yeah, I think, I think we're all going to get back to traveling, but it may be a while. So, other than a real, roulette wheel sort of trade in some of the really depressed cruise companies, that's not really my style. Sure, they're going to snap back a lot because they have a pretty high short positions, and that means that they're going to get wound up pretty tight just to rebound. So here's one of the questions I got. How bad will the economy be? Well, I think the best case scenario is we're going to see negative growth for 2 quarters. Jobless rate 20%. That's possible. I mean, I think we're going to know more in the next couple of weeks. But I think one should remember that some of the economic news, it doesn't go, in a typical bear market decline, it can go sort of tick by tick early on. So in other words, bad news, lower prices, bad news, lower prices. Then, whether you're talking to the overall market or individual company, what typically happens is that those start to diverge. So if with 20% jobless rate, for example, I mean, the government, whether not the forum to decide whether you're in favor of spending all this money or not, but they have the wherewithal to do it, and it looks like they're going to do it. And we can make some long-term, forecast of how bad that's going to be for everybody. But at this point, it's sort of it's a survival sort of market. So I think that even if it does get that low, I think a lot of people are going to be in better shape than they were in many of the last recessions when they didn't have that safety net. Another gentleman sent me this. How can you do if all these indicators are just at zero levels? Can you look? to determine where, where we're going to look at in the market and where, at when the market is bottoming. Let's look at some of those. Let's see, I'll change it back. So let's see, new share. Okay, so you should be in stock charts now. Whoever was helping me before. So this is one chart we featured before. This is a advanced decline differential. And it was just interesting that we talked about this in late, I think I first featured this at the end of 2018, showing that at that point, that was the most oversold it ever been since, the end of 2009. This goes back to 2006, I guess. So we've gotten more than that. So minus 680. It closed, that was a week ago. Now it's at minus 548. So this is sort of the rubber band thing. Doesn't mean that, the worst is over necessarily. It just means that, it's extremely sold out. And so that, the odds start to favor a rebound. You can see based on the chart, the NYSE composite has cracked through, it's back to that low we made in 2016 already. And the next low here is the 2011 high, which is around 9,500, I believe, 8,500, yes, 8,500. So we're into a good level of support here, but we could still go lower. Okay, this was one of the indicators the gentleman asked about everything so low. So, when we talked about the fact that it was saying high risk in January because we had these lower highs. So this measures, the number of NASDAQ 100 stocks above their 50-day moving average. So it's a following thing that I'm trying to. I'd been in the process before all this to trying to put a risk profile together, and this is one of the things I look at. So if this is really, below 30 and 20, it's in a low risk area, and if prices are, of course, below their weekly start bands, that's a favorable risk environment. And at the start of the year, we had neither of those. We're back above almost 80% of the stocks were above their 50-day. It's just simple numerics. If that many stocks are above their 50 days, the overall market is pretty rich. You could probably, and fundamental measures will dovetail with that to a certain extent, but they tell you that, there's fewer stocks that can go up. So, those of you who've been following me for a while, we've talked about this in the past. So when you get down in a strongly trending market, you can see in October, we got down to about 30, 35. August, same sort of thing. In July, before that slide, the correction into the August low, we got that same sort of divergence. So we're typically going to see, right now, I guess it's at 3. It's been as low as 0. And so before this bottoms out, it's probably going to spend some time going between, 3 currently, up to 20 or 25, and it's going to base out here. That's what's been observed in the past. So if you look at the longer term chart of the NASDAQ 100, you can see that it's also, the next support for it, this 69.36 area. That's not too far below, I think, 68.37, I guess, was the low. So, we dropped, was a drop below that on last week, but we're into a support area down to 64. You can also notice that we're at the S1, the yearly S1 pivot. Hopefully we're not doomed to test the S2. It was interesting that I think by the time that we hit the R1 resistance at 95.40, we got up to 97.36 before the bottom fell out. So the weekly, RS still looks positive. Unbalanced volume, okay, quite negative. Not maybe as negative as you would expect to see, with these 2 huge bars of volume in the past 2 weeks. But you can see that, the way, I analyze the OBV is if you connect, and we can do that. Let's see if we can do that without screwing things up too bad. So if you look at, that was sort of the breakout period. So we're back into that. Okay, the next, next level of support, you're going to want to see hold is that low right in here. So, I mean, I've been using this, and typically, so, you know, if the volume pattern continues to deteriorate and we get a rally and it just goes back to the moving average, and then that's the level you're going to watch for if things are going to get significantly worse. Conversely, you're going to want to look at that last peak we had 2 weeks ago and see if the unbalanced volume can get above that. So the volume on any, you know, rally is going to be important. And you know, that's essentially what that's telling you. Other indicators to watch to see when, you know, maybe the worst is over. So this is a put call ratio, and this is a CBOE put call, and the 10-day moving average, and this is the equity. So you know, they have both reached multi-year lows. You know, they see there. This is the 2016 or the low that we had. You know, recession low here. You can see there's more put buying there. Put buyers are only right for a while, and you know, this would suggest that, you know, they're probably should be starting to cover those. But until they turn up, you really don't have confirmation that the trend has changed. So that's something, you know, you can look in stock charts. They don't update them until the end of the day. $ CPC is the total, which is one I follow. And you know, you can. I think there's a couple of sites from the CBOE options exchange where they probably update that during the day. But that's that watch out. I mean, right now, you know, it's, you know, 1.3, you know, on a 10-day basis. You can see at this level here, that if you can see where my pointer is here, that was August of 2015. That was the first time that the Dow had been down 1,000 points up till recently. And so that was one of that day, you know, so the Dow was down like 1,000 in the first 15 minutes of trading, and you had all these, you know, you had the staple stocks, you know, that were opening, you know, 15-20% lower, you know, because the system really couldn't handle it. That's the last time it's been down. As you know, this is an inverted scale here. It's okay. So when this is at this level here, that means a very high put call ratio, 1.3. So 30% more puts are being bought than calls. And this is one, which is, you know, equity, which is typically, you know, on the equity side, because you have more covered call action. When this drops that low, it's also an extreme level of bearishness. Here we have the S&P, the 50-day also. It's 1.2, it says, I guess, is the last reading. You can see it's well below. It showed a similar formation here as the NASDAQ. New highs, new lows, they have been amazing. Based on their data, though, last week, we didn't quite see, you know, there's a slight divergence here. So the peak I show here is it was up like whatever, 2,600, 2,700. So last week it was not, you know, not quite as bad. You know, for a little trick for, let's see, what else do we have left? Okay. For those of you who are interested in like how to get the actual data, one thing you can do is just, so we're looking at the new TJ, new high, new low. Okay, so here's the new. So if you ever want to look at the underlying data, so I'm taking that symbol that's for the new lows. You can pop it into this field here, hit return. You'll get this chart that may not make much sense, but then if you look under, click under past data, you'll get these readings. You get the actual data. So 23, so these are, you know, they're all going to say the same because it's looking at the lows. So it's straight across. So you can see we had 1051. It hasn't updated for Thursday yet in their platform. It probably comes tonight. 22, 23, 2000. So on the 12th of March, it was 2377. So that's the divergence we're kind of seeing in there. So that's kind of your benchmark level to see the, you know, new lows. So, you know, if you see it drop now below probably 644, you can see there was a 688 low. That's going to be an encouraging sign. But anyway, that's how you can get the raw data out of stock charts. Took me a while to figure that out myself, but so a couple stocks. Somebody asked me about IDXX. It's been smacked pretty good, as you can see. So it's back down in here. So it's it's got a tough road here. I mean, 225. It's the first strong resistance. Typically, the first bounce here, you can't really, here, let's see, you can see a little bit better probably this way. So, between 208 and say about 215 is the first level of resistance. Okay, back in here, you can see, 213.50. Back to 207, is the initial 207. So that 207, that's 24 bucks above where we closed. So percentage wise, that's probably a 12% move. 225, up to the S1 on a yearly basis. That's going to be a tough barrier, up around 229. Don't really see, you can see the volume here was pretty extreme on the way down. So this is a long ways from bottoming. It started to, break down, in February. And so that's about the best case scenario for that one. You look at some of the, let's see, increase the size here. Thank you for your comment. Okay, so let's go. All these need to be increased. Bear with me. Okay, so this is, the 60-minute chart of the Qs. The Qs still look the best. I think I mentioned, those of you who follow me on Twitter, I think I said like 84.50 or something was a level I really wanted to see it get. That's where that came from. 84.68, 83.49, the rally, ran out of gas. You can see the on-balance volume is still not that bad a pattern. So, 166.80, I mean, that could still hold depending on what happens between now and Monday morning. Probably also depends on, theoretically they're having a vote in the Senate about the bill. So, I think that if they don't get that act together, even if they're going to do something more later on, I think they need to do something to help reassure people. So then once you, if you get a bottom completed, then you can see, 191.55. That's the pivot based on, that was last week's activity, but you can put together, where your chart resistance is, 192, 204 seems like a tough one. That was that one Thursday we had where we popped up and just quickly reversed. So that's kind of like the possible upside target. So from 178, 10 points or 10%, is going to be 17 points. So that takes you to 195. 34 points, that takes you up to 212, I believe. Doing this all in my head, so 212, that'd be a tough slide. So that's kind of how that chart looks like. Let's see what they got here. Yeah, I mean, this is the no real signs of this is once again the the triple leveraged long. It's had a pretty ugly move down. So where could it go to? Well, this 134.16 to 137 level. That's the first wall resistance. That's like potentially a double from where we are right now. But until you start to see some signs that it's really turning around, you haven't got that yet. You could probably if you look at this on a on an hourly basis, not looking a whole lot. Unfortunately, it's a whole lot cleaner at this point. Yeah, but that's what to do. Watch it. Then you got to really, particularly if somebody has a press conference, you have to really use a pretty tight stop under a 2-hour low or something until it really kicks into gear. I still think that's likely. Probably this week that we're going to see a pretty good bounce. but you can see back that, it's got a lot of, the rubber band is really stretched. It doesn't mean it's going to snap all the way back, but it does have some room to snap. And, from here. Okay, let's see. Well, I guess that was it. So let's look at, whoever's been so kind. So let's look at some of the scan charts. So what I do, for those of you who are looking at, a number of stocks, for example, they have these things on the front page. I think you can even see these if you're, a free person. These probably show up pretty tiny, but at least gives you an idea. So this is what I mean, like, if you look at, Cody, it had a doji, and sorry, I'm gonna have to keep trying to enlarge these. So, it looks like it, formed a doji on Thursday, and it had a doji buy signal on Friday. Nothing else is really positive. I mean, the volume has been pretty good in the past couple of days, so that's a good sign. But that just shows you, I think they might be a, sort of a cosmetic company, but that's what you want to look for. More importantly, maybe I should back up here and say, well, here's some of the ones. So MGM Grand, all these, Carnival, Mosaic Fertilizer Company, UAL had a nice bounce. You can, hopefully you can see this, but you can see these, look them in and say, well, okay, it closed well off the highs. You just kind of see what's moving here. And then if you pull down predefined groups, first thing I'd look at is the Dow stocks. Okay, so I look at all these, and to see which one last week, I noted there's some really positive action in Walgreens. And it had a nice bounce up to 50, 53 or 4. Now it's back down. So by looking at all these charts, you can show it. So what I would expect you would see when we're actually bottoming, you're going to pull up this screen, and you're going to see, more than 15 of these are probably going to move above last week's highs. That will most likely be the first sign that, okay, that short-term bottom is in place. You can see, Microsoft's one I like. I mean, it formed a doji, on Thursday too. You can't really tell it in here. So 150.15 is the level it's got to get above to trigger that doji buy signal. And you can see the relative performance there is acting quite good. Let's zap it up again. So it's come down. 134.78, 135 was the low, the last correction low. So I tend to go back and say, aha, 134.78, and it held above that. That's a slightly encouraging sign. Don't think Microsoft is going to go out of business. I think that I think that everything they produce, is a plus. So, so I think that they're a company. There's a couple other ones that one I've been talking about for a while, and kind of missed the boat here. Got one little opportunity back to 102. That's in Zoom. Obviously, what the platform we're all currently using. You see the technicals look really good. So, but I think it'll, it's probably, if the market decides the world is not ending, then Zoom will probably come back down. So you kind of can tell that, the 20-day EMA is at 111.76. And so, you have support around 119. I think that pivot, held, it had a low of 158. I think when I first talked about it, I said risking under 100. You had to be really nimble, and I think the lowest it got was like 108.85 or something on 108.85 on the 18th. So that was on Wednesday, and been pretty much off to the races. Another one that really was crowdsource was a favorite before the market collapsed. It got a huge move. So there's some things that are really starting to move. It was like, one thing I do is I look at this and I go, it's a larger size. I look at it and I go to a weekly chart and see what what it did weekly, and it was up 23.9% for the week. So not any real signs of a daily bottom, until I think Thursday's close, maybe. Yeah, right here is sort of that turned the on balance volume and the RS positive. Tough buy right in here, but certainly on a pullback, it would look more interesting. Let's go back to the dashboard again. Some of the other groups I look at. So then I look at S&P, I look at NASDAQ, and most of you can kind of look at a lot of the NASDAQ ones are very thin. So yeah, I mean this stock FRGI went from under $4 to over $11. That's a tough one to trade, but you can always look at candle glance, perspective, and and see what what's if anything looks interesting there. Other published groups, cryptocurrencies, international. I've been watching these because I think, but I think there's there are going to be some interesting opportunities overseas, mainly because of the fact that certain countries like South Korea, seems to have pulled through this okay. Amazing that Italy, after the horrible things there, it hasn't really dropped a new low at this point. But I think some of the European markets might be coming out of this pretty good because they really have had a tough economy, and valuation-wise, the value investors are going to start looking at some of these markets, and you can see a lot of them, like Switzerland, is something that you look for the ones that haven't made a new low with the market. So we can see once again it's too small, but hang on. So we made a low on Wednesday at whatever at 30.55, and now it's dropping back towards her. So you can see it's already outperforming versus the S&P. So it trades fairly liquid, and it's 1.7 million shares. So there are going to be some opportunities. Well, that's pretty much what I had prepared. Didn't take, but I'm open to questions if you guys want to hit that chat box. And I guess if we don't all talk at once, we could also go audio. Problem is that we get background noise, but I'm open to answer other questions that you may have of a specific market or individual stock.
Hey, Tom, it's Raymond. Great job. Can you go back to Zoom? I did nibble in a little bit, and I kicked myself for not getting more of it. Where would you put another buy in on that? Thank you.
Sure. Thank you, Raymond. So let's look at Zoom. I would drill down to to the hourly chart, Raymond, and I think that particularly in today's market, so you can see it gave way a little bit late in the day, so that's good. So I would be looking, soft landing, probably around 123.40 or so, right around in here, down to about 116.50. 116, you can see that I'd look at this high here, 116.50, 119.87, 117.76, sort of that cluster of levels there. And I think we really shouldn't get under that 108.85 low. I think we made, right here, like on first hour of trading on Wednesday, I guess. So if you want to put a really tight stop, that's where it'd go. Longer term, I think it has great potential. I mean, everyone working at home, this is the top platform to do it, and you can see that they obviously, we can think it's going to be the wave of the future. Okay, so all right. Well, let's look at somebody else wanted to look at Tesla. TSA. Okay, so let's see. Once again, so here's the. Okay, let's back it up a little bit first. Go with the weekly, and a few more months, obviously. Okay, well, it's getting right down to that yearly pivot, which is at 1 358 even, I guess. So the low last week was 350. So that's an encouraging sign. Volume obviously, was smaller than it was on the way up. So that's good. That's why the OBV, the weekly on balance volume, is positive. RS is positive. So, looking what I always start my analysis, I look at the weekly first. The weekly would say, well, this is encouraging. It may have seen the most of its decline. So then I would go back to the daily and see what that's telling me. And you can see that 350.51 level once again on Wednesday. So where's your stop going to be? So 327 is a swing low down in here. That's about the next. It's got 361 here. So we came down and we dropped below that 340.84. So, it looks to me like if it could pull back in there and you could see a bottom risking to maybe under 327. Let's look at the, this chart doesn't suggest that maybe the worst is over yet. Once again, we have too small a chart again. Change all those chart settings to a larger chart so you can see a little bit more about what we're talking about. But once again, the volume here, even on an hourly basis, there was a lot of heavy volume. 4.9 million, early on the 20th, and then as it started to tail off with the press conference, 3 million, 2.5, 1.2, 1.9, and then the last hour, 2.5. So that's an encouraging sign. So if you look at the hourly charts, then you kind of get that, that level, down that, okay, that 350 levels should hold. And you look at this sort of bars, the support around 387 down to 374. So, that's how I would look on Boeing. Boeing was even worse than I ever thought it was going to be a couple of years ago. So talking to a client, and I think he was in it around 370, and I was saying, unfortunately, these things never end well. But I never dreamed it'd be that. I have a nephew that is an engineer that works for Boeing, so it's a tough thing for everyone, and it's going to be interesting to see what the government does. So you can't really even see anything on this chart. So first of all, let's change the size, and now let's go back, 5 years. 5 years is probably not enough either. Nope. So, okay, 123, we cracked through that. It's about the 92.41, looks like was the low we had, right at that 2016 low. So right in here, 94.20 or so, and the low last week was 89. So, you're getting down there. Let's maybe back it up a couple more years and see if you had any other lows back in there. So, if it's going to find support, I can't imagine it's not ready to move. So, but you can see 92.41, not a lot of lows down, 81, I guess, 80, sort of that level. But I don't think it's, something that anyone's going to let go out of business. It's just too much of, too many related industries, that are, no matter how you feel about any kind of corporate bailout or malfeasance or whether they deserve it or not, it's probably going to be saved, I would say. And given the fact that, this rubber band is stats really, I guess what was the high? It was 425, 435, down to 95. It's got some room to move. You can see the volume clearly, is horrible. And if you look at, doesn't get any better when I do look at monthly charts in a lot of markets. That doesn't help you a lot here. 86, I guess there was a low at 86 here. Looks like in 86.66 that was in August of, that was during that August 24th, 1,000-point down day. It got down to 86. So I guess that's where your stop placement, or if you're a serious bottom fisher, that would probably be the place to look at. What other markets? Let's see. I looked at, those of you who've done classes with me, we can just kind of run through and see if we have some of the the AD line stuff I look at. Some of this is historical, so I'll glass over that. Oh, it's not going to be big enough, probably. Those I had this one. This is one of the differentials that I look at. I don't know how well it shows up. So this is the stocks only, advance minus decline. Another one of those things that's trying to bottom out here. You can me to low, higher low. So this is sort of the bottoming process you typically would see. Down below this are two different measures of the, of the advance of the McClellan oscillator, also showing divergences here. Two different formulas. Not much good here. Summation index on the NASDAQ and its AD line. Here we have, this is another look at the NASDAQ AD differential. You can see, even though we're close to the lows here, we're at minus 24. We were at minus 60. A series of higher lows here. You can see at the high here, we had a spike high and then a much weaker peak. So these are some of the AD lines, I'm looking for. All of these, so first phase of the rally, I mean, this is the S&P 600 small cap. I mean, it should just get back at least up to this 4,400 level. That'll allow the moving average to stop dropping so sharply and give you a chance. So, and if you want to know, there's only one, the NYAD, $NYAD is the only one they update during the day in stock charts. So it can kind of give you some interesting information, and on what everything is doing. I don't think there's anything else too interesting. So another look of the advanced decline differentials. It's a short-term thing, but it does tend to work. So I think that's I don't have a lot more. I haven't seen any Apple. Oh, okay. Yeah, I was liking Apple up till it kind of gave up the ghost on Friday. My stop in place was at under whatever it was, under 236 or something. It was creamed. Still, I think talk to some outside. I think it's sort of a unique situation. I don't think it's going out of business either. I think that we're probably, the more isolated we get, the more we're going to need a phone. I think it's got a unique brand. At least in my lifetime, I can't remember anything that has had a more brand loyalty than Apple. I mean, sort of you hate it or you love it, but so I don't think it's going to be out of business. And let's maybe go to a monthly chart for it. So where's the next possible? So you can see this 228, right, where it got into, one of the things, if you, some of you probably heard this from me before, but when you get a significant high like this was 228.67, so when we moved above that in last fall, that now becomes a significant level of support. That old resistance becomes support. So we're right down there. We got 228 on Friday, 228.67. Yeah, so that's a port level. You look down at, this is a monthly chart. So you can look at monthly highs down 212. Monthly low 213. 3. So it's getting right down there. It's just dropped below the pivot. The yearly pivot, the yearly support is at 193.42. You can see the RS is still really positive, as is the unbalanced volume. So it looked to me like that was just probably an overshoot on Friday, that either somebody read something they didn't like or just was so distressed over what they were hearing on TV. They just dumped the whole thing. It was a thin market. Let's look at the, just out of curiosity, let's look at the hourly chart, see what the volume was. We can see anything about the volume. Yeah, it was pretty heavy volume in that last hour. We should be consistent with that. Like, don't want to hold it over the weekend. Yeah, this one, I mean, it closed at 3 o'clock at 41.56 and then dropped to 228 in the last hour. So, this hourly chart still looks like it's trying to build a bottom. Now it's got to get above, 252.84 to be really, enthused about a bottoming process. That's if you're trading these things short term and you get an upturn like this, I can't really do it in my newsletters, but essentially, once you saw this high at 252.84, that was the number you wanted to see overcome if you were long Apple to stay long. And you can see we made it to 51.83, 51.82, 51.77. So it couldn't get back above that 52.82 level. So that was sort of a sign of weakness. And of course, you can drop it down. I mean, most stocks, the intraday volume and indicators is not as good, but something like Apple, it's so liquid, it does do a pretty good job. And you can kind of see that rolling over that sideways pattern here for a good part of Friday. From the open, it had a little spurt, and then it was sort of drifting lower. That wasn't a great sign. So let's see if we can look at the. Oops. So the VIX. Oh, let's see. We have a little larger this time around. 85. I mean, where does it have to go? Maybe drop below 56. That's 11 points below that. I mean, it's really stretch tight, and so I think it's, if it drops that level, then we're looking to 50, 49.50, and then 41 or so is probably the next likely level. In their format, only uses next, and so the questions really help. So don't feel free to, send those in. I'll keep them for the next time around. Well, thank you and take care.